Welcome to the Tech Today podcast. It's your host, John Maeda, with the Christmas special entitled Inflation is Immoral. We wrote a piece to that end earlier today and just wanted to do a brief video recap or overview, if you will, of that piece. So, why is inflation immoral? Well, because it is a tax imposed on Americans. It's not a tax that we get to vote on. It's a tax that's imposed on us. Frankly, it's a tax imposed on anyone who purchases goods and services in the United States while inflation is in effect. And so why is it that the Fed's 2% inflation target is acceptable? Why do people readily accept that? So income taxes, we get to sort of vote on indirectly by voting on those we put in power in Congress and in the Oval Office. As is the case with all taxes and regulation, we have indirect say. At the end of the day, lobbyists and corporate interests carry more weight by writing checks to those in Congress, whether it's a direct check or it's a kickback or a cryptocurrency payment. But in the case of inflation, there really is no vote, direct or indirect. And there are two parties to blame, the fiscal side and the monetary side. And forgive me if some of this is repetitive, but it is Christmas. And there is no more moral discussion than inflation. So on the fiscal side, and we included this detail in our article today, we consistently spend, we being the federal government, not we the people, but the federal government consistently spends above its means. Fiscal 2023, the fiscal deficit was 1.7 trillion. Year to date, fiscal 24, the deficit is about 13% higher than it was in fiscal 23 year to date. So we're right on track for a kind of a $2 trillion-ish deficit in fiscal 2024. And so that deficit has to be accounted for. You just can't roll that fiscal hole over every year. You've got to plug that hole. And so the way we plug the hole, and I shouldn't say we, because it's not we the people, but it's the federal government. The way the federal government plugs the hole is Treasury issues debt, the proceeds of which are used to plug that hole. Just the way Treasury issues debt to fund federal spending, any overspending is funded in the same manner. And then who purchases that debt? Well, historically, Japan picked up a lot of the slack. They purchased a fair amount of that debt that was issued by Treasury every year. And then some 10, 12 years ago, China was the big buyer. Now Japan and China purchase significantly less. In fact, the Treasury holdings by each country have sort of flatlined over the past number of years and trended slightly downward. And so the Federal Reserve has been the one left holding the bag. They have had to pick up the slack. And the Fed has filled the hole. Now, during QT, the Fed has purchased less and less in the way of treasuries and fiscal, or rather in calendar 2023. The Fed has trimmed its treasury holdings by approximately $700 billion. So they're not the buyer they once were, although that's going to change. That's going to change. And they were a buyer when Treasury issued all that paper back in November. And they will continue to be a buyer because there isn't another buyer of scale. And Treasury has to issue a whole bunch of new debt to fund, even though we don't yet have a budget for fiscal 2024. There'll be another continuing resolution That'll get funded with new paper, and the Fed's going to be the big buyer. So the Fed is complicit in Treasury's overspending by way of subsidizing the debt, by printing new dollars to buy Treasury's new issues. And so by definition, the moment the Fed prints new dollars, it is devaluing the currency. And so if you look at, M2, the money supply over 2021, 2022, the money supply grew by about 40%. So you could argue that the Fed devalued the currency by 40% over those 2 years. And frankly, growth in the money supply, I think, is a better indicator of the dollar's purchasing power or dollar devaluation than is CPI. CPI is, that number is significantly understated. If you want to use CPI, that's fine. We use CPI in the article that we published today simply because it's easy to track. It tells the same story. CPI makes the dollar devaluation story a little bit more palatable, but not palatable. I think the example we gave in the article was if you had $100 today and you stuck it in the mattress and held it there in the mattress for 20 years, and if you assume that the Fed inflates the economy, i.e. CPI, by 2% a year, that $100 is going to be worth roughly $67 20 years from now. But of course, inflation, i.e. CPI growth, will be a lot more than 2% a year on average. You'll have massive spikes like we had in 2021 and 2022. And so, therefore, how can we fix the problem? Well, the easy way would be for fiscal spending to rein that in, for the federal government to radically reduce fiscal spending such that we're not generating deficits, but that we're generating significant surpluses. That would cure the inflation problem. That would cure the massive debt problem. Because in that example I provided earlier, when the Treasury is in the position of having to fill the fiscal hole with new debt, that of course grows the outstanding debt level, which today stands at $34 trillion. So one way is to radically reduce spending. That's not going to happen because that's how both parties stay in office, is to use fiscal dollars to allocate those fiscal dollars to various subsidization programs that provide income assistance and various permutations of welfare. I think in fiscal 22, fiscal 23, roughly 70% of fiscal spending went to some form of a welfare program or another. So I don't expect either party to cut spending for fear of pissing off their constituents, which would lead to less votes come election time. The other way to, which is just sort of a, if radically reducing fiscal spending is one, then going back on the gold standard is 1A. Putting the US dollar back on the gold standard, recall that President Nixon took us off in August 1971, but putting the United States back on the gold standard would be another way of reducing fiscal spending. Because in putting the United States back on the gold standard, you're basically tethering currency to gold reserves. And so you could not print currency out of thin air as we do today unless you had all of or a portion of those new printed dollars in gold reserves. So you're pegging the dollar to gold reserves to one degree or another. So that, by definition, would curb spending. So that's not going to happen because Washington simply does not want to curb spending. So how will this problem resolve itself? Well, if you just game theory this out, the dollar eventually goes to zero. You can't devalue a currency in perpetuity. Eventually, it's going to go to zero. And if you look at the dollar versus gold, it depends exactly where you look in 1971. But the dollar since 1971, when we came off of the gold standard, has lost 98, 99% of its value against gold. So the more we continue to print and devalue the currency versus gold, eventually we will be in a hyperinflation situation whereby a dozen eggs costs $50, $100. A roll of toilet paper costs $50. The currency will be worthless, and we'll have no choice but to go back onto a gold standard. And at that time, of course, the United States will lose its reserve currency status. It won't be able to print currency out of thin air. And so I don't know if that's 10 years out, 5 years out, 25 years out. It will be a function of, largely be a function of the next crisis or the next couple of crises. Do we have another COVID-like event in which Washington, D.C. would use that as an excuse to print, ungodly sums of money again? These various wars that the United States has going on, they're not forcing the Fed to print money, forcing Treasury to issue new debt at the same pace as we did during the COVID lockdowns, but they're for sure adding to the inflation problem, adding to the dollar devaluation problem, adding to the fiscal deficit problem, albeit at a slower pace than we had during 2020, 2021, 2022 as a result of COVID, with the CARES Act and related spending, where we grew the money supply by it's almost $7 trillion over a 2-year period. But these wars will do it. Various green initiatives under the Biden administration and other administrations like the Obama administration for sure exacerbated the problem. The next thing that could hit us out of left field will for sure exacerbate the problem. COVID 2.0. But until then, if we don't have a crisis, manufactured or otherwise, staring us in the face, why is it readily acceptable that 2% inflation, 2% annual inflation is okay? It's not okay. Why not have 2% dollar appreciation, 2% annual dollar appreciation? Well, why ought not that be the goal for the United States? It's a rhetorical question. Obviously, the reason why is because dollar appreciation is in direct conflict with what the government wants to do in terms of fiscal spending. So that's something Treasury will never tell you. That's something the Federal Reserve will never tell you. But that's the truth. That's all for now. Merry Christmas. See you next time.